Today's sponsor is Public.com. You'll get one free stock when you go to public.com/meetkevin to download the Public app. That's public.com/meetkevin. More on them in just a moment. Just make sure when you go there, follow me and you'll get one free stock. Links also in the description. Hey everyone, Meet Kevin here. 2 months ago, I posted this video called How the Complete Collapse of Cryptocurrencies Would Happen. It has 194,000 views. And folks, yesterday evening, a new piece came out from Bloomberg that basically feels like it watched my video, did a whole crap ton of research, and gave us the scenario as to how what I speculated about potentially could happen 2 months ago could actually happen. And they gave us the stats and data. And I'm like, I need to share this with y'all because it's a little intense. Let me give you a quick background. In case you didn't watch that video or didn't remember that video, let me give you a very, very simple introduction to this, and then we're going to get into the stats and figures. So buckle up. This gets a little, it gets intense. All right, so very basic overview. You've heard of stable coins before. Maybe you haven't. Maybe you've just heard of Tether, or you've heard, and this is not just the Tether FUD video, don't worry. Or you've heard about the Gemini dollar or coin USA, whatever. You've heard about these different coins before that basically say, hey, your coin is worth $1. It's pegged to the dollar. So the value of the coin is $1. And the purpose of having the USDC, whatever, the US stablecoin, the purpose of this is to be able to transact cryptocurrencies faster. We don't have to wait for your US dollar to show up. We could give you a coin, and rather than trying to wire US dollars around or other currencies around, which are subject to government regulation, especially in China, where, Chinese government isn't really too fond of cryptocurrency right now. Hey, if you had stablecoin, well, stablecoins, those aren't the renminbi, so it's something that's not regulated and gives you more freedoms. So anyway, stablecoins have this allure of easier blockchain transactions because they're on the blockchain. But they're also pegged to the dollar, so the argument is that they'll always be worth $1. And there are many companies that have or use these stablecoins, and they offer interest on these stablecoins. And in my video from 2 months ago, I talked about how there's a real dangerous opportunity for rehypothecation to get out of hand and for massive lending combined with a price decline in cryptocurrencies to lead to a complete collapse of stablecoins. Now, stablecoins drop or collapse generally when they do something known as breaking the dollar. So here's the thing. When you have a Gemini coin, you believe it is worth $1. And that makes sense because Gemini tells you, hey, look, we audit our stablecoin so that we have 106 million Gemini dollars in circulation, and we have $106 million in an account. Well, that's fine. When you read the footnote, you notice that these are actually not just sitting in cash. They're invested into Goldman Sachs money market funds and treasury securities. Fine, let's call those relatively safe and relatively worth $1. But the issue that I came up with in my other video wasn't necessarily that the Gemini dollar would break the dollar, although it's possible, and this is why every time there seems to be a little bit of panic in the crypto spaces, you immediately see brokerages start freezing withdrawals. It's a concern. But what was a bigger issue with my Gemini dollar video was how many times are these $106 million lent out? See, because if I have Gemini dollars and I want to earn, with Gemini Earn or whatever, I want to earn 5% on my Gemini dollar and I authorize the lending out of this, well, that could have been done 10, 20 different times. We don't know how many times it could have been done. Gemini dollars could literally be worth, instead of $106 million, which honestly feels a little low, could be worth 10, 20, 50, $100 billion. The market cap or the amount of money circulating based in the Gemini dollar, based on loaned out versions of these existing assets, could be massive. So you could literally have 1 million people out there looking and going, oh yeah, I got a ton of Gemini dollars, thinking it's a savings account, when in reality, because they signed up for earning interest, they've lent it out. And now the potential is that if for some reason the lending market collapses one day, they may no longer be able to redeem their Gemini dollars for dollars because all of these other people are basically going bankrupt in some kind of liquidity crisis or some kind of freezing of withdrawals. Totally possible. And this is how cryptocurrencies, in that video from 2 months ago, this is how I overall made the argument that there is a risk factor when it comes to stablecoins. They're not guaranteed to be at $1, especially if you're turning on that that lending aspect, and lots of things could screw up the market. Now, we overall went through that sort of scenario, and we're like, okay, yeah, it could happen, but hey, we'd have to see a pretty large drop in Bitcoin pricing and the pricing of other crypto assets. Well, guess what's happened over the last 2 months? We've seen cryptos fall a good sizable chunk. Now, they're not like massively sold off. It's not like we're at Bitcoin 5,000 and that. But this brings up the Bloomberg article. And see, this is where I really wonder, did Bloomberg, and credit to them, okay? Did Bloomberg see my video? And I'm not trying to take credit for this, okay? But then go really deep on the research, because the research and what I'm going to show you is very, very good. It's incredibly good. Now, it is an opinion piece, but let's put that aside. Let's look at some of the research and let's just draw some conclusions, okay? So I'm going to show you the article. We're going to go through the most important pieces of it together. That brings us to today's sponsor, public.com/meetkevin, an investing app where you can buy and sell stocks, follow investors, and share ideas. Public is the best place to invest, especially if you want to follow other users' portfolios or see what your friends or other people you follow are investing in. For example, I really love that I'm about to invest in Google, Alphabet, and I see this little icon over here at the top right, or when I scroll down, I see here people you follow who also own or watch this stock, and I see Graham's in here, and I gotta own more Google than Graham does, okay? Google pays me on YouTube, you know, love Google. I think that's pretty neat. I joined Public, so you can see my Public portfolio as well if you search for @MeetKevin in the app. Keep this in mind, Public does not sell your data or information to third parties or market makers like other investment apps. And Alphabet, I'm going in on this. You'll get to see how much I'm buying, especially as I transfer more money on over to the Public app. So check this out. Make sure you get that free stock when you go to public.com/meetkevin. Download the Public app. Once again, that's public.com/meetkevin. Follow me there and get one free stock. The link is also in the description. All right, so the piece starts off by talking about how in 2008, there was a run on a Lehman Brothers money market fund worth $64.8 billion because 1.2% of the fund's assets became worthless. So just 1.2% became worthless, and the markets freaked out, and everybody wanted to get their money because now all of a sudden things weren't worth $1 anymore. They were basically worth 98.8 cents. And all of a sudden, there was this massive run on money markets. And the only way the episode of this massive run ended was the Treasury Department came in and basically guaranteed all money market funds. Now, what's really interesting about money market funds is, yeah, sure, the Treasury Department, the government, the SEC, whatever, the Federal Reserve, they can come bail you out. But guess who they're not going to bail out? If there's ever a run on stable coins, because the government don't like stable coins. At least from what we could tell so far. Maybe they'll have like a central bank digital currency in the future. We know they're working on that. But it's very interesting. You do not have Mr. Bailout Man coming to save you. Or woman. Because we got Janet Yellen, okay? We got Jerome Powell and Janet Yellen. And so this is where they go into cryptocurrencies. And specifically, they point out Tether. Now, again, this is not just Tether FUD. I want to go through, and I know some of it's going to seem a little fuddish, but I want to go through some of the stats because they're very, very interesting, and we'll draw conclusions here, okay? So take a look at this. We know that Tethers are supposed to be pegged to $1, and Tether says that the dollar is backed up by whatever Tether's reserves are. Well, here's what Tether's reserves are made up of. 50% is in commercial paper. Remember how at Lehman Brothers, 1.2% was in commercial paper that became worthless? And with 1.2%, there was a massive run on all money markets that the Treasury Department had to bail out? Okay, Tether has 50% of their reserves in commercial paper, with no details provided about the quality. Fiduciary deposits represented 18%, but more troubling, they say, 10% was in corporate bonds, funds, and precious metals, and 13% were in secured loans to miscellaneous entities that we have no idea about. And then there was 1 to 2% which of basically Tether money that goes into other, which can include other digital coins. So in other words, people could be like putting their money into Tether, borrowing against their Tether to invest in cryptocurrencies, but then Tether itself can be investing in, if they wanted to, junk bonds, other loans, or other coins. And so it creates this insane buildup of assets that are actually not backed by a dollar. They're backed by commercial loans, which we have no idea how good they are, other tokens, corporate bonds. Like this right here, this is a scary paragraph. And I am always concerned that how many other stable coins are doing this kind of stuff. Now again, Gemini says, no, we use the treasuries. But is it all in treasuries? I don't know. I have no idea. It's money market. See here, we'll go back really quick to, not CNBC, there we go. Gemini dollar accounts are held and maintained by State Street Bank and Trust, which, keep in mind, they like to say, oh, well, there's pass-through FDIC insurance on this. Don't kid yourself. You're only getting FDIC insurance if that bank fails, not if the stable coin fails. Now, they're saying that the Gemini dollars are invested into, treasuries here, which is good. But keep this in mind that the Gemini dollar is actually the smaller of the stable coins. Tether is the biggest one. Tether's huge. I mean, let's look at it really quick. Gemini dollar is at about 106 million. You could go to CoinMarketCap right now and just look at this, for example. Tether's market cap is $61 billion. It's literally, let's see, 61,000 divided by 107, something like that. Hold on, let's grab it really quick here. Yeah, 107. All right. It's 570 times as large. Tether is 570 times as large. So even that Gemini might be okay. Doesn't remove the risk of all that rehypothecation that's going on. But the United States Tether is at $62 billion of a market cap. $80.9 billion of it has been transacted in the last 24 hours. That's 2.5 times as much as Bitcoin gets transacted. Tether's very, very important to the crypto market. And that is a scary diversification in terms of how they're investing their crypto reserves. All right. So then we also have fine print that says Tether, and we know this, has the right to delay any redemption or withdrawal if such delay is necessitated by the illiquidity or unavailability or loss of any reserves. In other words, if they can't give you your money because people are running the bank and everybody wants their money out of Tether, they have the right to pause withdrawals. Now, they also make this clarification that here a real money market fund would never be allowed to do that because they're regulated by the Security and Exchange Commission, and there are only certain things you can invest your money into. But Tether doesn't have any of those requirements, and their auditing requirements are whatever they want. So we don't know, like with Gemini, we don't know how many times it's lent out, and where does the money go when it's lent out? We don't know to whom it's being lent. We don't know where those Tethers are going. Gemini is probably a lot safer than Tether, given where Tether is putting all their money, but holy smokas. And so we notice here's a little bit more talk about, look at this. A JP Morgan research report earlier this year said that 50 to 60% of all Bitcoin trades are for Tether, and that a sudden loss of confidence in Tether would likely generate a severe liquidity shock to Bitcoin markets. And so this is how you can see, like, it's all kind of tied together. And then we also talk here about, particularly because of the recent rise in crypto prices that we've seen over the last few months in general, right? If we go 6 months back to now, not like the last few weeks where we've had a little bit of a sell-off. But the argument here is that we know that leverage has gone up. But the problem is we don't know how much leverage there is in the stablecoin market and in the crypto market. And so that's dangerous. So if we continue to see prices fall and then liquidity goes down, you could see withdrawals get shut down for Tether, and that could lead to some big old issues. But wait a minute. Who has all the Tether? Well, check this out. Approximately 65% of Tether tokens are held through the Chinese exchange Huobi, and that it could be that Chinese investors convert renminbi into Tether in order to trade other cryptocurrencies while avoiding legal or regulatory constraints. Remember, China does not like cryptos, right? And this is the scarier part. So a ton of it, 65% is in China, but the scarier part is that the top 10 Tether addresses hold a quarter of the market, and the top 100 hold 41% of all tokens. So it does not take a lot of people to start dumping Tether to have a massive, scary result in the crypto market. Then they talk a little bit about how Libra was supposed to be this world stablecoin, but politicians were afraid this would undermine United States sovereignty or country sovereignty. But fear not, Tether has its reserves at a small bank in the Bahamas. So don't worry, it's good. All the money's over at the Bahamas. But then they end the article by saying, hey, maybe we should just have a little bit more clarity and regulation on these stablecoins. And folks, I hate to say it, but it's literally what we talked about 2 months ago, that we have so little knowledge about where the stablecoin money is going and all of the lending that's happening in the stablecoin market that we don't actually know how much of cryptocurrency prices are just propped up by debt upon debt, but not just debt upon debt. Debt issued on the belief that the underlying asset is worth $1, when in reality, the underlying asset is actually just somebody else's debt, like a corporate bond or a junk bond or whatever. You have to always ask yourself, why is it that they can pay you 4%, 5%, 8% on your stable coins? It just seems a little too good to be true that you could put your savings into a stable coin, get 8% and not be exposed to some risk. So I'm a little concerned. If you want to read the article yourself, they did change the title. It's Can a Cryptocurrency Break the Buck? I was posted yesterday. I thought it was a really, really, really good piece. This is something to pay attention to. What my recommendation here is, well, look, first of all, I like the idea of being able to buy the dip in cryptocurrencies, but I am deathly afraid of how much unknown leverage there is in the crypto markets, and I've been talking about this for months. I've got maybe, right now, about 2% of my portfolio. No, that's wrong. I've got about 1.4% of my portfolio in Bitcoin and Ethereum. That's it. Look, I love the premise of cryptos, but, and I'm not just trying to do the, FUD, sell everything. Look, I'm not selling. I'm looking at buying dips, but this kind of stuff makes me a little nervous from going like all in or going heavier in. These are just things that I think are very valid to pay attention to. It's not something that's just like, let's FUD, sell everything. No. It's just when you're an investor, you want to be aware of the upsides and the downsides. And this is one area that is worth paying attention to. Thank you so much for watching this video, folks. I'm excited to talk to you again in the future. Let's get another video going. Subscribe if you like this kind of content. And folks, we'll see you in the next one. Thanks so much. Bye.